Train derailments happening around the country continue to put people at great risk of injury, as well as a variety of other risks, posing major threats to healthy living, clean air, clean water, and now added to the impacted will also include the ability to maintain employment, stay gainfully employed, and produce income. The same income that's needed so that families can continue to pay their mortgages, pay their rent, pay for food, water, and other basic necessities, pay water, power, and other energy bills, and avoid foreclosure or possible eviction. Last year, we all experienced the record highs of diesel prices that were not only at risk of running out in just a matter of days, but also witnessed the squeezed margins at logistics companies across the country. Today, we are seeing increased challenges with recent confirmation released by DOT, having confirmed that a state Department of Transportation truck that belonged to a contractor collided and hit the CSX Railroad Bridge over Onondaga Lake Parkway. I think I said that correctly. Onondaga Lake Parkway? I don't know which one that is. Sparking debate between the locals and the multi-billion-dollar record profit-seeking setting freight railway companies also includes the latest release from BNSF after having been issued final 2 permits needed for bridge teardown and construction after there's been a long-standing heated debate over whether the rail bridge that spans the Missouri River between Bismarck and Mandan will be repurposed or demolished. Now, for now, it looks like that debate is over after the North Dakota Department of Water Resources issued 2 permits to BNSF. Surprise, surprise. Now, BNSF says it has now obtained all the permits and approvals to go ahead and tear down the bridge and build a new one. Deforestation has begun and trees in the area are being removed for this now $100 million project that will span the next 4 years at a minimum. BNSF said a new bridge will benefit North Dakota's major industries as well as the nation's supply chain, and I will explain to you all why that is a major area that we must focus on today. So please do me a favor, hit the like button and subscribe to the channel if you haven't already. Check out the free links in the description for the best ways to buy gold and silver, hard assets, and physically protect and store your crypto keys off the exchange. So as I mentioned in the beginning of this video, logistics companies are on the brink of a massive slowdown, hardship, and huge question marks on what to do next as we enter into this deep recession, just as freight rates have fallen amidst a new challenge that has emerged: low demand. And as explained by the president of the Owner-Operator Independent Drivers Association, Todd Spencer, said, "Now we're in a situation where there are too many trucks for available loads, and that the reduced freight activity represents a marked shift from just 1 year ago when pent-up consumer demand far exceeded supply as retailers struggled to maintain inventory levels." And just last week, the president of the nation's largest trucking company declared a freight recession. That's right. J.B. Hunt is describing this as a development that could signal a broader downturn in the U.S. economy. Recent reports and figures calculated by the American Trucking Association's ATA Truck Tonnage Index, which is an indicator of demand, fell 5.4% from the month before, which is also its largest monthly drop since the start of the pandemic in April of 2020. And folks, that's just not good. That index largely takes into account contract freight, but data suggests the spot freight market has been hit much harder. And the spot market is going to cause serious damage to the financial balance sheets of the smaller, hotshot owner-operators out there fighting for loads each and every day. These feast or famine loads will become highly sought after as the economy recedes and is recessed after this next move by the Fed, which is likely to result in another damaging interest rate hike or maybe a pause at best. We are waiting to see what Jerome Powell shares at the next Fed meeting, but no matter how you look at it, the freight hauling and trucking industry is about to get cutthroat. The spot market, which smaller carriers are more likely to rely on, is the one-time price to move a load based on the current market rate. Sorry about that little slowdown. I had a phone call coming in. And spot load postings last month were down nearly 70% compared to March of last year. Now, this is all according to the DAT Freight and Analytics. And businesses like Freight Horse Express LLC were rolling last year pretty good, but now, nope, not the same. He has multiple rigs parked along with new trailer beds which are stacked and unused. A true sign of the times and a much more meaningful indication as to the direction of how which way our economy is heading, if not already there and we just don't know it yet. Before I go any further, the reason why we wouldn't know it yet is because you're not necessarily directly tied to this industry, and it takes a little bit of time to trickle down and ultimately permeate throughout our economy, which we are all interconnected. Now, folks, there are going to be so many people who are about to get a crash course and an accelerated lesson in the education of economic and social issues with what is heading our way, for sure, no doubt about that. Modern money mechanics that they just don't teach you in schools. And while banks are pulling back and tightening up on lending as the population's majority lacks the savings ability and doesn't have the resources available, liquid, to cover an emergency expense of $500. Last year, people were paying between $25,000 to $30,000 for an import container, but now that demand today on the spot market is down around $1,000. Ouch. And I suspect that this will only become increasingly more volatile and hurt bottom lines as less shipping containers in the near future as the EU Parliament finalizes emissions trading rules for shipping. And this is an important one, because according to the Maritime Executive, the European Parliament has given its final stamp of approval to a package of climate measures at the heart of its Fit for 55 emissions scheme, which aims to cut the bloc's overall greenhouse gas footprint by 55% over the next couple years. The legislation brings shipping into the EU's emissions trading system, the ETS, for the very first time, pulling vessel emissions into the European carbon market with a phase-in period beginning next year and setting targets to be reached by as early as 2030. The measure is the product of extended negotiations between the EU Parliament, Commission and Council, and still requires final sign-off by the national representatives on the Council. Crucially, the package will allocate 20 million ETS allowances worth about $2 billion at current value to supporting the decarbonization of shipping, a key demand from the industry. All said to be effective ways of addressing the climate crisis and decarbonizing shipping as less of a question of if, but a question of how. The requirement will phase in over a 3-year period, and it incorporates another key demand from European ship owners: a mandatory tax pass-through to charterers who determine ship owners' routes, speeds, and fuel consumption, and therefore emissions. And under the polluter pays principle, the new legislation recognizes the charterer as the ultimate source of the CO2, though the tax is administered on the ship owners. So expect to pay more money. So owners of large cargo ships will be required to pay for allowances covering 40% of emissions in 2024, 70% in 2025, and 100% from 2026 and on. So it seems pretty clear to me that this will cause one of two things to happen, and they're either shipping will be drastically reduced and thus further hurting and negatively impacting local freight and last mile deliveries after having made a drastic cut and a reduction of available employment opportunities at ports, or increased costs associated with all imports and exports in order for goods and materials to make their way to consumers and end users, i.e., in layman's terms, more inflation and much more higher prices. Or even worse, both. Both of these grim outcomes could come to fruition. And as trucking demand has fallen, so has diesel prices. Today, at the time of recording this video, a gallon of diesel cost about $4.17 on average, down from an all-time high of $5.82 last summer. And this is according to the American Automobile Association, the AAA numbers from June. Now, I know you may think that this is a good update and this is good news and potentially a step in the right direction in bringing down prices. But, however, unfortunately, benchmark diesel futures being down nearly 25% this year and domestic demand down almost 8.5% respectively since the same time last year, according to reports from the Wall Street Journal, this only reveals a much worse situation that is right in front of us, and that is that this is yet another clear sign of the nation's industrial slowdown. Recession. Diesel demand being down is an indicator of something pretty much point blank, frankly, much worse happening in our economy. Many small business truckers got in at the peak of the market, hoping to find an alternative way of making money and surviving after having lost their corporate jobs or having been exhausted by the runaround of gig work delivery like Grubhub, DoorDash, and Uber Eats, and now find themselves saddled with expensive equipment, loads of debt, tons of overhead, massive amounts of anxiety, and an overwhelming amount of stress. Worried about the future and the potential likelihood of total collapse and failure, with some already having gone out of business and their equipment been repossessed. A look at the bright side? Well, maybe, I don't know. Is that the typical past year's summer produce coming out of places like California can help to boost spot trucking rates. But unfortunately, as we have discussed in recent video uploads on this channel, there are growing fears this year's storms have made that less likely. So we can just add that to another one of the freight indicators that's also pointing into the direction of an economic slowdown. Container imports at U.S. ports are down compared to last year, and on Wall Street, transportation stocks have fallen into recent months. They've just continuously gone down. Consumer spending rose at a 1% annual rate last quarter, which is in fact the weakest quarterly gain in consumer spending since C-19 arrived in the spring of 2020. All bad news, folks. And discretionary spending on physical goods like appliances and furniture also fell for the fourth straight quarter. I'm just going to be blunt. Time to buckle up, folks. The writing is on the wall. So the underlying message here is simple. It really is when you think about it. And let it all sink in, please. As well, if you aren't quite sure what that really is, what that message is, and what it could mean, big picture wise, and ultimately what it could mean for you and your family, then please feel free to replay this video again, because I'm sure the more you watch and listen, the clearer and easier it will be for you to understand the challenges that we will all soon face. So let's have a quick little Q&A to conclude and recap. So what happens next? When we go into a deep recession, how will that impact all of these people? Well, recessions reduce opportunities and in turn result in failed businesses. fewer jobs, and lower wages. So now is the countdown and the start of the time to prepare if you haven't already. I really hope that's not the case, because what comes next is almost certainly likely to be far worse than what we've experienced so far.